Hello, Professor Bloxham, or whoever may else be watching this. This is my money and banking presentation. So, I was looking into different articles to choose, and I went through The Economist. Nothing was really appealing. Then I went through the Wall Street Journal, a famous news source. Thought that would be a nice one to find. And a lot of the articles really weren't appealing to me. Then I came across this one. The New York Fed adds about $33.6 billion to the financial system. This article was actually published this morning, so it's very, very recent. And it was written by Robert Barba. I thought that this fit a lot and correlated very well to the thing that we were talking about in class, as well as something that just sparked my interest in general. So I understand what the Fed means, and I understand the financial system, so I was wondering how it worked out that they were able to give such a substantial amount of money to these banks. So a little background on the Fed, for those of you who may not know. The Fed serves as basically the central bank of the United States. Its power is to oversee a lot of the smaller central banks that are going on around the country. So, we all use the banks, such as your local ones, to do our debit and credit, to do our checking and make just basic transactions. Well, this kind of serves as the oversight to all of those banks that we have. They regulate monetary policy, and like I said, they regulate the U.S. banking system. Within this Fed, they have a board of governors. These board of governors make a lot of the executive decisions that the Fed decides to execute. Those people are elected in, and obviously if they're in the position they're in, they have a lot of credentials. And then there's the 12 regional Federal Reserve banks. So these are also put in the major cities throughout the United States. This should make sense because the banks need to be where the money is. So it makes a lot of sense and corresponds pretty well to having those banks be in the top major cities throughout the United States because there's the most regulation that needs to be done. The responsibility is to make sure that the supply of money isn't growing too much, and it's also not growing too little. That way the purchasing power of the dollar is increasing a lot. So they do this in a couple different ways. The first way is they regulate the percentage of deposits that banks are able to make and able to retain. And then they also, they can change the discount rate that banks have, which basically is the cost of borrowing money. So such as taking out a mortgage on your house, you're taking out that money, but you also have to pay interest back on it because that is the cost of borrowing that money. So the Fed plays a large role in all of the regulations around that. They have a lot to do with this article that I read. So the article was just diving into a little bit. So like I said, the Federal Reserve was able to give them $33.6 billion, which is a pretty substantial amount. Not very little, something that definitely strikes a Wall Street Journal news article. So what they did is they did this in the purpose of the addition was to relieve the pressure on the money markets. And from what I took away from that was the banks are not able to pay these back. And when they're not able to pay these back, a few different problems happen. First of all, the investors are not happy. Also, it shows the bank does not have a lot of money in circulation that they're able to pay back the people that they are not necessarily obligated to pay back, but the ones who they promised at first a return in order to raise capital for them. Like I said before, the money markets are not obligated to be paid back, so they're not necessarily in a big crunch, but it's definitely something that requires the Fed to step in and take place. With that being said, in return, the bank serves as sort of a lender, the Fed does. So what this is they offer collateral of U.S. Treasury and mortgage securities. So one question that kind of came to mind right away is banks were using the Treasury bills and the short mortgage securities as a way to raise capital for themselves. And if they're already having a little bit of capital in place, how is that going to work where the Fed now owns those and they're not able to raise capital in the immediate future? So I thought that was pretty interesting to look at. Like I said, the Fed also acts as a lender. So in agreement to give them the amounts, they reached out and needed the amount. They gave the collateral of the U.S. Treasury and the mortgage securities from the bank. And one thing that I read about this that I thought was very interesting was financial companies have been scrambling to find overnight funding. So immediate funding for them, like I said before, is the Treasury and the mortgage securities, but those were no longer able to be put into place, so when they had to resort to the Fed. So why do they do this? Like I said, The Fed began offering repo loans, as they're called, which is the same situation we've been talking about 2 weeks ago, because of the shortage of available cash inside of the financial system. Even if you have no idea what I'm talking about, that doesn't sound good, does it? It's the financial system, and there's not enough cash in circulation. So the people that these are kind of hurting are the banks, like I said, because they're no longer able to pay them back. Also, just the financial system in general. With this being said, if there's not a lot of cash in circulation, interest rates are going to increase. And this is something that we saw a lot of in the financial crisis, which kind of brings me to my next point. This sort of activity is the first time this has happened since the financial crisis. So this is the first time they've had to take these sort of actions since then. And if you're reading up on a lot of what the big-time investors are saying, it's already looking like we're heading towards almost a pretty big recession in the next couple of years. So for an article like this to come out, I'm really curious to see how this will move forward in the future. I want to read up on how the big-time investors will respond to something like this happening. To be honest, I don't have that answer, and I'm not really sure how they're going to, but it's definitely something to look forward to in the next couple of weeks. So here are my thoughts. I touched on this a little bit ago. I'm wondering how the banks proceed from here. Yes, they got this massive amount of a loan from the Fed, $33.6 billion, which is huge, but they're holding their mortgage securities and U.S. Treasury bills as collateral. So how else are they going to be raising capital if they're already getting a big chunk from the Fed and they're not able to raise immediate capital? So I thought that was really interesting, and that's also something I'm going to be looking forward to the next couple of weeks. And then the biggest question of them all, are we actually headed for another crisis? Because if this activity is not being shown for 11 years ago, and ironically enough was the time of the financial crisis, that's an immediate indicator that this might actually be a thing. And if there's not a lot of cash in circulation, that's showing that they're going to need to put out bonds and fixed income securities that are offering at a really high interest rate. So investors are not going to be very appealed to them. Also, they're not going to be able to pay those back, and the safety of those bonds and other fixed income securities are not going to be very high. So I'm wondering how that's also going to play out, but that might be a year or two away before we start seeing things like that. So who's impacted by this? The big question of them all. Banks all over, specifically in the New York area, because these were the banks that got the massive fund from the Fed, and also the Fed itself. So the Fed obviously has a massive portfolio. $33 billion to us is insane. I mean, let's be honest, if I got that, my life would look a lot different than it does now. But the Fed is, if it's dropping a check of that much, the money's coming from somewhere. Somebody can't get that money. So I'm also interested to see how that plays out as well. And like I keep saying, this article is very new, so a lot of the information around what we're talking about hasn't fully been put out yet, but it's some nice indicators going forward. And also the workforce in general. I know one big problem that happened with the crisis before was the retirement accounts end up dropping near the age of retirement. A lot of our parents are probably near that age. That might be something for them to look into, and that might be something that overall affects them in a pretty bad way. So the workforce might not be able to recover very well from this, but we'll see how that plays out. And then let's relate this to classmates. As I was saying before, if another financial crisis does happen, which obviously I'm speaking in dramatic measures here, retirement accounts will be dramatically affected. Not so much ours because we're 40, 50 years away from it, but our parents. And our parents' financial situation always has a lot, blanking on the word here, but it interacts a lot with ours. And then layoffs can always happen. Funding's tight, jobs are going to have to go. Or the thing too is what could happen is 2008, people in the financial system aren't going to be one to dealing with some problems that they know they have on their desk. So the easiest course of action for them is just to get a nice brown bin and pick up their stuff and head out the door. And that is all that I have for today. Thank you.